A crash course for equity financings in the mining sector. Mining exploration companies typically raise capital by issuing new shares by way of private placements. Every distribution of securities requires a prospectus unless an exemption is available. An offering memorandum is one exemption that can be used. A prospectus is a document filed and approved by regulators that outlines in detail the business of a company to investors. Offering memorandums are similar in purpose but do not require the same levels of regulatory approval. Only certain investors are exempt from investing in the securities of a company without a prospectus, and these include accredited investors, institutional investors, employees and associates of the issuing company. There are three types of securities generally sold in a private placement: common shares, flow-through shares, and warrants. Common shares. Common shares are the basic units of a company equity. Common shareholders have a vote in the election of the board of directors and carry the profit or loss risk. Flow-through shares. Flow-through shares offer the holder the same ownership rights as a common share, but also offer tax deductions to the investor holding them. Resource companies can flow through the mining exploration tax deductions they receive to these investors. Warrants. A warrant gives the holder the right, but not the obligation, to buy a common share at a certain price until a specified expiry date. Warrants can lower risk and provide additional returns if the share value increases. Units. These securities are arranged and sold in units. Typically, one share is packaged with one warrant, but other combinations exist. New shares added in a private placement will dilute the share structure for people previously invested, but add new capital for the company. Hold periods occur when securities purchased in a private placement cannot be resold or exercised for a minimum of 4 months. Example: Mr. Brimley, an accredited investor, wishes to buy shares in BC Mining Inc., a fictional exploration company used for presentation purposes. Scenario 1. He purchases shares for VCX on the open market. He bids 12 cents per share and buys 100,000 common shares. VCX performs well and the share price rises to 18 cents. After 1 year, Mr. Brimley decides to liquidate his position. The advantage of this scenario is there is no holding period, meaning Brimley can sell his shares when he likes. Scenario 2. The following year, Mr. Brimley hears VCX has opened a private placement. Because he is accredited, Mr. Brimley is eligible to participate. The terms of the deal carry a 4-month hold period and consist of flow-through units at 10 cents per share. Each flow-through unit consists of 1 common share and 1 warrant, which entitles the holder to purchase 1 common share for 15 cents and expires 2 years from the purchase date. VCX performs well and the share price rises to 18 cents. After 16 months, Mr. Brimley decides to sell his shares and warrants. Advantages of this scenario include the flow-through tax credits, plus the warrants offer additional upside potential. Private placements allow mining companies to raise additional capital and can potentially provide investors with more upside and higher returns than investing in the same company in the public market. To view the full infographic, visit visualcapitalist.com. For information about companies currently offering private placements, visit the Venture Radar at vadar.ca. This motion graphic is brought to you by Visual Capitalist, Cambridge House International, and the Venture Radar.